The Monetary Policy Committee met on 6th, 7th and 8th August. After a detailed assessment of the evolving macroeconomic and financial conditions and the overall outlook, it decided by a majority of 4:2 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25% and the marginal standing facility rate and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. So as you can see, there is good amount of convergence between market expectations and the RBI's policies. In other words, both market expectations and RBI policies, so far as monetary policy is concerned, are well aligned. I shall now briefly set out the rationale for these decisions. Headline inflation, after remaining steady at 4.8% during April and May this year, increased to 5.1% in June, primarily driven by the food component, which remains stubborn. While the fuel group remained in deflation. The expected moderation in headline inflation during the second quarter of 24-25, that is in the second quarter of the current financial year, on account of favorable base effects, is likely to reverse in the third quarter. This is something which I had also explained in the last monetary policy meeting in June, that in the third quarter we have a substantial advantage of the base effect, which may pull down the overall inflation numbers. But going forward, that base effect will wear out. Domestic growth, however, in these circumstances is holding up well on the back of steady urban consumption and improving rural consumption, coupled with strong investment demand. Amidst this confluence of factors, the MPC judged that it is important for monetary policy to stay the course while maintaining close vigil on the inflation trajectory and the risks thereof. Resilient and steady growth in GDP enables monetary policy to focus unambiguously on inflation. It must continue to be disinflationary and resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Accordingly, the Monetary Policy Committee decided to keep the policy repo rate unchanged at 6.5% in this meeting. The commitment of monetary policy to ensure price stability would strengthen the foundations for a period of sustained growth. Now, this point needs to be appreciated, that ensuring price stability eventually results and supports a period of sustained growth. Without price stability, high growth cannot be sustained. So therefore, especially in a situation where our GDP growth is holding up well, we have decided to focus on inflation and ensure price stability, mainly to support growth. In these circumstances, the MPC reiterated the need to continue with the disinflationary stance of withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and inflation conditions in India. But before that, let me briefly touch upon the global growth scenario. Global economic outlook exhibits steady, though uneven expansion. Manufacturing is indicating slowdown, while services activity is holding up. Notwithstanding sticky services prices, inflation is receding grudgingly across major economies. With varying outlook for growth and inflation across countries, monetary policy is showing signs of divergence across jurisdictions. Several central banks are cautiously moving towards policy pivots, though through forward guidance and rate cuts. While at the same time, there has been tightening by a few central banks also. So on the one hand, you have several central banks which are moving towards a rate cut scenario, but on the other hand, you have a few economies which are on a rate hike mode. Global financial markets are exhibiting volatility. Bond yields and the dollar index have softened since the last meeting of the MPC in June. While the near-term outlook looks positive, I'm talking about global growth. While the near-term outlook looks positive, there are significant challenges to medium-term global growth outlook. Demographic shifts, climate change, geopolitical tensions and fragmentations, rising public debt, and new technologies such as artificial intelligence pose new sets of challenges. A coherent policy approach in which monetary policy is complemented by other policies to manage the policy trade-offs will be crucial to deal with such multiple challenges. Let me now turn to domestic growth. Domestic economic activity continues to be resilient. On the supply side, steady progress in southwest monsoon, higher cumulative kharif sowing, and improving reservoir levels augur very well for the kharif output. The likelihood of La Nina conditions developing during the second half of the monsoon season is likely to have a bearing on agricultural production in the current financial year. Manufacturing activity continues to gain ground on the back of improving domestic demand. The Index of Industrial Production, that is IIP, growth accelerated in May this year. Purchasing Managers Index, that is PMI for manufacturing, at 58.1 in July remained elevated. Services sector maintained buoyancy as evidenced by the available high-frequency indicators. Now, when I say high-frequency indicators, I have given a lot of details in the footnote of my statement, which, as you would know, will get uploaded immediately my statement is over. In fact, for almost, most of the statements which I am making, there is a lot of backup data which we have given in the footnotes. So in the interest of time, I am not reading out that data, but it is there in the footnote. So when the statement is uploaded, I would encourage you to please have a look at it. Similarly, PMI services stood strong at 60.3 in July and is above 60 for 7 consecutive months, indicating robust expansion of services. On the demand side, household consumption is supporting a turnaround in rural demand and steady discretionary spending in urban areas. Fixed investment activity remained buoyant amid government's continued thrust on capex and other policy support from the government. Private corporate investment is gaining steam on the back of expansion in bank credit. Merchandise exports expanded in June, although at a slower pace.